So guys, welcome back to my YouTube channel. We're going to be covering some of the biggest mistakes that FX traders make when they take a position, and it's to do with how you manage your trade. So if that's you, stick around because I'm going to show you exactly what you're doing wrong. Don't forget to thumbs up, comment and subscribe. So guys, this video is brought to you by our sponsor FX Choice. They are an FX and stock brokerage with tight spreads. If you want to find out a little bit more about them, check the description of this video and head over to their site and give it a read. So the biggest problem that we see from people that go through training, trading, and checking and analyzing traders' results is that a lot of traders, especially retail traders, move their stop loss to break even far too quickly. Now this can be caused by a vast majority of different reasons. It could be fear of loss, that you might lose now, you're in a slight bit of profit, you don't want to give it back. But a lot of traders are moving their stop loss to break even when they're only literally in a tiny bit of profit, maybe 5-6 pips in profit. They're moving their stop loss to break even in the hopes that they're now mentally they feel safe, because when price comes back down, they're not now going to lose money. If it carries on going, they're going to make a lot more money. Now actually, by moving to break even, it's actually detrimental to your trading, especially on intraday trading on low time frames such as the 5 minutes, 15 minutes and so on and so forth. This is an issue because of the whipsawing in the markets. Once you've entered into the markets, set your stop loss in a reasonable place and your target in a reasonable place, and then leave it. So how do you get around this? You want to protect your position once you are in the money, but you don't want to be in a position where you're locking in too quickly to give money back to the markets. I do not move to break even on any of my trades, because you'll probably find that you hit break even more so than you do hitting your TP, hitting your take profit. So you'll find that if you go through and look at your trades, on those trades that you moved to break even and price came back down, spiked you out, and you came out with a very minor / break even position, it then only went on to go and hit where your target would have been. So you should use two types of stop losses to overcome this, okay? You use your initial stop loss position and you have your take profit, which will get you out of the market once it's hit your target. That is option one, which is just literally set and forget and leave it. I then use a second option, which is called time kill. For most people that trade the FX markets in the UK, we trade between literally 8 in the morning and 4:30 PM time. So what I can do is I'm just going to set a time kill. So basically at 4:30 PM, I'm going to come back, review my position and close the trade based off of the fact that it hasn't hit my take profit and it hasn't hit my stop loss. This is another way to get out of the markets. Having a systematic approach to the trading of the FX markets is a lot better than using your emotions, because it takes a lot of time to build up these professional discretionary sort of angles to approach the markets. And if you're very new, you're not going to have that approach to this. So all you should be doing is not moving to break even. When you move to break even, that is where you're going to be damaging your probability over the long term to be successful as an FX trader. So guys, we are looking at euro against the US dollar, and we're talking about why moving to break even can be harmful. So a prime example here is if we look at price here. Usually when I'm trading, what I'm going to be doing is I'm going to be entering into the markets on a pullback. Here we can see that it's bouncing off the markets. In fact, we could even look like, let's say we entered in here, which is early. It's not the optimal point, and we wanted to target the previous high. So when we're targeting the previous high up here, it's roughly 30 pips. So you're going to want to have at least a 15 pip stop loss. That is your 2-to-1, okay? Well, what a lot of people would do is we moved up a little bit, it came back down, and then we had this big bar up here and we're halfway towards our target. We're up 15 pips. A lot of these beginners are putting their stop loss and they're now moving up to break even. And guess what happens? The next 2 bars, it comes down, whipsaws you out, and then it carries on for the rest of the day. It moves all the way up and hits your take profit. That is exactly what we want to avoid and make sure that we're staying away from. Same again would have happened the previous day as well. You know, we said that we wanted to go for a buy position just out of the blue here. I'm just using this as a reference point, but let's say we wanted to buy in here. we wanted to target the previous highs, so around 25 pips, and price comes up. Let's say your stop loss was down here, it's 20 pips or whatever, or even 15, and it was tucked away below this trend line as an example, and you're going for a 1-to-1, price goes up in your favor, you move to break even, it whipsaws you out, and then later that day carries on going up and it hits your take profit. This is exactly what we want to avoid on a day-to-day basis by not moving to break even. If we were to buy into this trade and had our TP at the previous highs, it would have been hit. If we entered in here and had our TP at the previous highs, it also would have been hit. Let's use another example. Let's say that we bought in roughly here and we targeted the previous highs, yeah? So we bought in here and it's now 8:45 at night, it's rather late. So you don't want this to run on, if we go through the night, you don't want it to carry on going the previous day, do you? For the next day. So 24 hours intraday trading is what we're after. So what would you do? If we was to enter in here and target the previous highs, it definitely didn't hit that. If you came back at your time kill, let's say it was 6 or 12 hours, 12 hours is going to be 8 a.m. in the morning, which is, a hefty enough amount of time. 12 hours is around here. You would have closed the trade out around here, still in profit, but not near where your TP is. Or if it's later on today, it's already coming up here at 5 o'clock. You could look at closing the position out and, doing that. If you move to break even, you can see how many times it came back down and touched your entry before moving up in your direction. It's about playing this safe. So let's not move to break even. Let's use the 2 stop losses as discussed, which is stick with the take profit or have a time kill, whether that's 12 hours or 24 hours. Most traders just take one trade and it hits their stop loss, take profit, or as I was just saying, they move it to break even. You really want to let your winners run. So if you catch a really good move, for example, after oil crashed, and we saw that crash now, we knew that was going to rebound. So once your trade is in profit and it's just about to hit your TP, you can always remove your take profit and then move your stop loss up to lock in below the previous swing low if you're buying, for example. Then what you can do is open another position in the markets, and then once you've got that position in, we're now scaling into your winners. This means that your losses become small, but when you catch a winner, you can really scale into that position and maximize your profits. Scaling in is really underrated, and it's something that you should do more of once you catch a winner. Especially, for example, if we was to look at the recent COVID crash on the Dow Jones, also, global indices, there was a huge opportunity for a rebound, and you could have scaled into that position nicely, locking in profit along the way, just trailing swing lows over the long term and making those wins really count. So scaling into the market to help you get a better price, let's use a reference here, and let's use, for example, the Dow Jones. Very, very fluctuating at the moment. We look on the daily, it's been very, very strong. So you can see how the price had a pullback here. This was because the Fed was talking about raising interest rates, although it wasn't, it was badly factored in, but it's not really going to cause much damage. So over this time period, if we look at the daily, you can see how we have recovered from the crash of COVID. Now, if you were scaling into this on a daily basis, you could trail the bar lows from the swing lows, scale in. Let's say you bought in down the dip, moves up, creates 1, creates 2 pullbacks. You can then move your stop loss below there, enter again, moves up, pulls back, move both stop losses below here, enter again, moves up, pulls back, move stop losses below here, moves up, pulls back, move all of your stop losses up here, and you would have then got stopped out, but you would have managed to scale in and benefit from all of that profit. And again, likewise, if you was doing that here, for example, pullback, buying in, moves up, you're still in the trade, comes back down, you see the reversal, you move your trade from your first trade to swing low, and you're entering again. You're now in 2 trades, it's moving up, third pullback, put them below here, both this stop loss up here and this stop loss up here, and then carries on moving again, and you carry on locking in that profit. So that is how you can scale in more effectively in the markets and make your winners count and your losers small. Again, I use this stuff on the likes of Dow Jones, FTSE, commodities, things like that. I tend not to do this on a 5 or 15 minute time frame on currency pairs because it's just not as effective. The third and final one is taking partial profits. Taking partial profits is something that you shouldn't do. A lot of people are like, I'm going to take a little bit off the table and I'm going to leave the rest to run. Now, the problem with this is if it carries on running, you're now losing out on the full gains that you would, initially get. And this is all again to do with your mental stability and emotions to the approach that you have in the markets and how much you value money. You have to think of this again in a systematic approach. If you are making that conscious decision to take money off of the table, it's because that you feel that the position is going to fail or it's not going to carry on going. And if that's the case, you should probably close the entire position. So you should either be all in or all out, if that makes sense. Unless, for example, you're about to hit your take profit, okay? And it's a really nice position. You're taking majority off of the table. But in all sense, I really wouldn't even do that because, for example, let's say you're risking 1%, it's about to hit your take profit for a 2% gain. You take 1% off of the table and you still have 1% on and it comes back down. Now your probability of success has been lowered because you've only achieved a 1-to-1 profit factor ratio rather than getting a 2-to-1. So you then have to calculate that into your system of how many times will that happen or how many times will it carry on running. This is why it's a lot more simple just to stick with your targets, stick with your stop losses and really focus on your core strategy, because once you then let a trade run, it then becomes discretionary of, well, how long do I leave this to run for? How far is enough? Or now it's come back down towards my entry. Do I close that out or do I leave it to carry on going again? There's so many more factors that you have to take in which will affect your decision making and again, affect your long-term success if that decision isn't the same every single time. We are looking at pound against the US dollar here with our cluster on here. Now, taking partial profits on here is not something that I would advise doing because, for example, let's say we took this cluster signal here, we entered in the trade and it came up to the previous high and you're like, right, now I'm going to take partial profits, leave one on the table and it carries on going. You're like, yes, look at it keep going. Did you make that decision to exit your second trade now with more profit or did you leave it? Because if you left it, it came all the way back down and would have gone past your previous entry. So taking partial profits on the 5 and 15 minutes when it's so choppy is not something that I do, and it's not something that I've really ever seen a retail or a pro trader actually make money from partial trading on low time frames, such as the 5 and 15 minute time frames, because trading through this, having that factor of when is enough profit to then take your second one off the table is difficult to factor into a trading strategy and not something that I think is feasible. So if not for me, I definitely do not do partial profit release. I will either take it all off the table because I've made the decision that it's going to slow down now, or I leave them both on and lock under a swing low or something along those lines. That, guys, gives us a rough summary there of how you can take advantage of these retail errors that a lot of traders are taking in the market that we see time and time again. Don't be that guy, take advantage of these tips, and I wish you all the best in your trading. So guys, this video was brought to you by not only myself, but also our sponsor, FX Choice. The link is in the description of this video if you want to find out a little bit more about this FX and stock brokerage. They have got amazing spreads and great customer support. So head over to their website and find out a little bit more about them. Thanks for watching. Don't forget to thumbs up, comment and subscribe, and stick around because next week we're going to be covering more information about the FX markets and how to be a better trader.